right, Module 1 is Financial Accounting for MBAs, which is just an overview like Chapter 1s tend to be. And we cover 5 learning objectives: the users and suppliers of financial statements, secondly, the accounting equation and the 4 basic financial statements, which is the core of all accounting. This particular learning objective is something that if you understand it, it then becomes that first bit of foundation for this course and your ability to know accounting and finance. Third is show a little bit about the basics of profitability analysis. Fourth is to look at accounting principles, oversight, and regulations, kind of the profession, if you will, of accounting. And finally, look at the context of competitive analysis. And this is because financial data is not only used for finance, it's also used for marketing, for operations, for competitive analysis. And we're trying to make that connection on how it fits in. So the first is users and suppliers, and you might say, who cares? A lot of people care. So who cares would be stakeholders. Stakeholders could be, of course, owners of the company. They want to know how it's going. Customers, they want to know that the company they've chosen to buy from will be around and have some viability in terms of their own financial survival. Employees care because everyone wants to work for a company that's doing well so that they can have a career and see both promotions and raises. Suppliers matter because suppliers need to get paid. And if you're in bad financial position, suppliers may think twice about selling you things because you may not pay them. Conversely, if you're doing really well, high growth, suppliers will be fighting to be your selected vendor. So suppliers will look at it. Lenders, again, obviously, if somebody's lending you money, they want to make sure you're doing well. So bankers are all over financial statements before they make the loan and during their loan. Government cares because, for lack of any other one, taxes, right? So income taxes are charged to corporations, and government has a vested interest in making sure companies do well and pay their taxes. Community matters because they are where people live. It's your employees, and an employment base is important for every community. So that and your practices at being a good corporate citizen are of concern to communities. And the society in general, this gets into kind of areas I'm quite interested in. Are you kind of not only thinking about profits? There's an organization called Net Impact. I hope many of you look into it and join a club. And it looks at profit, planet, and people, right? The 3 Ps. Profit, we all need profit to sustain our business or we won't be around. People is how do you treat people? Your own people, your customers, your suppliers. And planet, are you responsible in terms of sustainability practices to not harm the environment? So all of these stakeholders have an interest in looking at your financial statements. And we'll go through these in more detail as we look at the statements and what information it contains. Sources of financial statements are, you've heard of annual reports. It is law that corporations must provide at least once a year financial statements to their owners. If you're a publicly traded company, you're listed on the NASDAQ or New York Stock Exchange, you must report quarterly in addition to a full annual statement. So these are required statements, whether you're a private company or a public company. Proxy statements, proxy just means that they're seeking your proxy. They're seeking your permission to have them vote for you. So proxy statements are meant to convince you of things, right? Because if they're asking for your permission, they have to give you information so that you're comfortable giving your permission. So proxy statements are a great source of data because they have to disclose things in an understandable way, at least hopefully understandable way, to the owners and the general public. For publicly traded companies, as mentioned, there are more requirements than a private one. The items that are most useful for us in our projects and in the future, the first is Form 10K. 10K is the annual report that is required for all publicly traded companies. So it has not only the numbers, but it also has notes, and it also has management's discussion of how the company is doing. It's called the MD&A, Management Discussion and Analysis, and they must provide information to you assessing their own performance. So this is very important and good reading for people trying to analyze how a company is doing. It's not solely your source because you have to check out with objective sources, but it's a great starting point. Next is Form 10Q. Q gives you the hint, it's quarterly. So these are the shorter list of information required on a quarterly basis. And so every 3 months we can see how a company is doing and not have to wait for a whole 12-month cycle. So disclosures is, why tell anyone anything, right? The answer is you wouldn't if you didn't have to. I mean, I'm being a little bit harsh, but most business people are pretty secretive about their business. They don't want to tell people their revenues, their profits, how much money they're making on different products. So disclosures are required under GAAP, under generally accepted accounting principles. Now, there are great benefits because it will then provide information to the markets, whether capital markets for investors, labor markets to entice people to join you, input markets such as suppliers, output as your customers. And the other is cost of capital. If you provide more information, then the people who are in the business of giving you money by loans or stock will feel more comfortable and perhaps give you a higher price, higher value for your stock because they are very happy to invest in your company. So disclosure gives comfort to people doing analysis. Next is recruiting. If you're recruiting and you're not telling anything, the likelihood of getting your top candidates is small. But if you are doing well and you're sharing it with recruits, it gives them information and reason to join your company. And suppliers and customers, same thing. They want to invest their companies and their livelihood with strong companies. So disclosures have benefits, even though the knee-jerk reaction might be to tell nothing to people, but actually disclosure helps you. The cost of disclosure is just the cost of preparing the information. And there are disadvantages to be sure, because whatever you publish, your competitors will read. You can be sure that every company that you compete with is going to look at your 10K to see what they might glean from that, to learn about what you're doing so they could prepare competitive reaction or maybe preempt some moves that you're thinking of doing by their own actions, right? So you have to be a little careful with what you disclose because it is to the public, including your competition. Litigation is one where we look at who is suing the company if it reaches a certain level of seriousness and probability. Political costs affect regulators or political opinion of your company. So there are implications on what you disclose to the general public. And finally, there are regulations about disclosure, what must be disclosed. And generally, the SEC is there to make sure disclosures are to all. So you don't tell some investors some information and did not tell it to others. That is a violation of US law. The standards are now a bit of a mess because each country has the right to create their own standards of reporting. And so over the years, we've had generally accepted accounting principles in the US, in the UK, in Japan, in Germany, etc., but it wasn't one set of standards. So there's an important movement that has been underway now for many years to try to standardize all of the accounting practices into one agreed upon reporting standard. And that is called the International Financial Reporting Standards, IFRS. And it is being directed and developed by the International Accounting Standards Board, IASB. So they're trying to create IFRS so everyone does it. Now, there are huge advantages for this. If you're an investor and you only understand the GAAP from your home country, it makes it pretty hard for you to feel comfortable analyzing a company from another country. But if the standards are the same, then your knowledge of how to analyze financials would cross borders, which would then facilitate the flow of capital across borders. So one of the main reasons for IFRS is that we can see more free movement of debt and equity capital across borders. Convergence is the word that depicts what's happening in the US. Converging means coming together. So we're to converge the US GAAP with the IFRS to come into an agreed upon IFRS. That has not happened. There are reasons, some kind of credible and some less credible, on why that hasn't happened. The fact is it has not happened, and it is something the SEC is pushing, and so it will happen over time. So convergence is the process by which the US standards will start converging with the IFRS. And the degrees of differences are pretty subtle in terms of the standards themselves, but there are some technical differences that are significant enough for them not to be consensus, right? So those are the items that are being negotiated or debated. And we'll cover a few of those examples. This is not a course on comparative accounting systems. We're looking at US GAAP primarily, but we will from time to time show some of the bigger differences so that you're aware why what's the big deal? Why don't they just come to agreement? I'll share some of the differences and why both parties have their points of view.